Hello, my name is Laureen with Alphaline Realty Group. Whether you're buying your home in your city or across the country, this video will help you make a smart, confident decision. We're diving into the real hidden costs of home ownership in 2025, the things most buyers overlook. And if you want even more clarity, I'll put together a step-by-step guide to walk you through the entire process. It's available now for just $19.99, and it could save you thousands. Stick around till the end for the link to grab your copy. Until then, enjoy the video. Think you're ready to buy? Think again.
Buying a home is one of the biggest financial steps most people will ever take. But while many people focus only on the down payment, there are actually several other major costs involved. Some of them are expected, like closing costs. Others, like reserve funds or moving expenses, often catch buyers off guard. If you're planning to buy a home in 2025, it's critical to understand these hidden costs. They can affect your approval, delay your closing, or even prevent you from buying the home altogether. So in this video, we're going to break it all down in plain language. By the end, you'll have a complete picture of what it truly takes to afford your first home.
Down payments. What no one tells you.
Let's start with the most well-known cost, the down payment. The down payment is the portion of the home's purchase price you pay up front. Depending on your loan type, you might need anywhere from 0 to 20%. For example, a 3% down payment on a $350,000 home is $10,500. If you put down 20% to avoid mortgage insurance, that would be $70,000. Your loan type and credit score usually determine what's available to you. Many first-time buyers qualify for 3 to 5% down options, which can be a huge help. But remember, just because your down payment is low doesn't mean your total upfront cost will be.
Which mortgage is right for you?
There are 4 main loan types buyers typically use: conventional, FHA, VA, and USDA. Conventional loans often require a minimum of 3 to 5% down. They work best for borrowers with strong credit scores and lower debt. FHA loans are backed by the government and require just 3.5% down. They're popular among buyers with lower credit or limited savings. VA loans are available to veterans and active duty service members, often with 0 down and no PMI. USDA loans are also 0 down options, but only for rural and certain suburban areas. Each loan type has its own pros, cons, and eligibility rules, so it's important to choose wisely.
Why that 3.5% is not the whole story.
Let's say you choose an FHA loan and plan to buy a $350,000 home. At 3.5% down, you'd need $12,250 up front. But that's only one piece of the puzzle. Next, you need to prepare for closing costs, which can add thousands more. Closing costs typically range from 2 to 5% of the loan amount. That means another $7,000 to $17,500 depending on the size of your mortgage. These fees pay for the appraisal, title search, taxes, insurance setup, and more. And unless your seller agrees to cover them, you're responsible for every dollar.
Closing cost. The sneaky budget killer.
Lenders will give you a loan estimate early in the process. This document outlines your estimated closing costs in detail. It's important to review it carefully and ask questions if anything is unclear. Some fees are fixed, while others can be negotiated or reduced. You might even be able to roll certain fees into your mortgage balance, but that increases your monthly payment. Remember, these closing costs are in addition to your down payment. So if you're buying a $350,000 home with 5% down and 4% closing costs, you'll need over $31,000. This is why so many buyers are surprised by how much cash they really need to close.
The hidden requirements that could sink your loan.
There's another big cost many buyers overlook: reserve funds. These are extra savings you must have in the bank after you pay your down payment and closing costs. Lenders want to see you can handle emergencies like a job loss or unexpected expense. Typically, they require 2 to 3 months of mortgage payments in reserve. So, if your mortgage will be $2,000 a month, that's $4,000 to $6,000 just sitting in your account. You won't spend this money right away, but you do need to prove it's there. Some buyers get denied late in the process simply because they don't meet the reserve requirement. Planning for this ahead of time can save you from delays and stress during closing.
The real cost to buy a $350,000 home.
Let's look at a full example using real numbers. Say you're buying a $350,000 home with 5% down. That's $17,500. Then add 4% for closing costs, which is $14,000. Now add $4,000 in reserve funds and maybe $2,000 for early inspection or deposits. You're already up to $37,500 in upfront cash needed to close. And that doesn't include moving or setup costs. Most buyers who only plan for the down payment end up scrambling. That's why we recommend building a full budget before you make an offer.
Moving day math. It adds up quick.
Now let's talk about moving costs. Whether you're relocating across town or from another state, moving can be expensive. Local moves typically cost $1,000 to $2,000 if you hire professionals. Long-distance moves, especially cross-country, can cost $5,000 to $10,000 or more. If you're doing it yourself, you'll still need to rent a truck, buy boxes, and take time off work. And don't forget about gas, hotels, or meals if you're traveling far. It's easy to underestimate these costs when you're focused on the home itself. But budgeting for the move is just as important as budgeting for the purchase.
Welcome home. Now pay for this too.
Then there are setup costs once you're in the home. You might need to buy a washer, dryer, refrigerator, or other appliances. There's also furniture, blinds, curtain rods, and basic home tools. If you're moving from an apartment, you may have none of these yet. Utilities will also require deposits. Electricity, water, internet, and gas often ask for $100, $300 up front. All these small expenses can add up to thousands very quickly. If you're not prepared, you could end up using credit cards just to settle in. And that's not the financial start you want with a brand new mortgage.
PMI, the fee that does not help you.
Let's not forget about private mortgage insurance, or PMI. If you put down less than 20% on a conventional loan, you'll likely have to pay this. PMI protects the lender, not you, in case you stop making payments. It's added to your monthly mortgage, typically costing $100 to $300 per month. That's another $1,200 to $3,600 per year in added housing cost. Some buyers aren't aware of PMI until they see their final payment amount. You can avoid PMI by putting down 20% or more. But if that's not possible, at least know how it affects your monthly budget.
How to ditch PMI and save big.
PMI isn't permanent, and that's the good news. Once you've built up 20% equity in your home, you can usually request to have it removed. Sometimes it drops off automatically depending on your loan terms. In other cases, you'll need to refinance or request a formal removal. The key is tracking your equity through payments and home value increases. Ask your lender up front how PMI works for your specific mortgage. Knowing the exit plan makes paying it a little easier in the short term, and it helps you plan for future savings once the PMI goes away.
Property taxes and insurance equals ouch.
In addition to PMI, you'll also be responsible for property taxes and homeowner's insurance. These are often bundled into your monthly mortgage payment in something called escrow. That means your lender collects a little each month and pays those bills for you when they're due. This makes budgeting easier, but it also increases your monthly payment. Property taxes vary by location, but in places like San Antonio, they can be over 2% of the home's value. That's $7,000 to $8,000 a year on a $350,000 home. Homeowner's insurance can add another $1,000 to $2,000 annually. Together, these can easily add $600 or more to your monthly housing bill.
HOA fees. What are you really paying for?
Some neighborhoods also charge HOA fees, homeowners association dues. These can range from $25 per month to several $100s. The fee usually depends on the amenities and services offered. Gated communities, pools, fitness centers, or landscaping services can all increase the cost. Some HOAs charge annual fees instead of monthly ones. It's important to ask about HOA fees when you're viewing homes, not after you've made an offer. They affect your monthly affordability just like taxes and insurance. And they can vary dramatically between neighborhoods, even within the same city.
Let's build a real monthly budget.
So let's put all of this together to see what a real monthly payment might look like. Start with your principal and interest. On a $350,000 loan at 6% interest, that's about $2,100. Add $400 for property taxes and another $150 for homeowner's insurance. Then factor in $200 for PMI if you didn't put 20% down. Now throw in $100 for an HOA fee if applicable. That gives you a total monthly housing cost of around $2,950. It's a big jump from just looking at the base mortgage payment, and it's why a full budget is so important before you fall in love with a house.
Why pre-approval letters does not always mean you are good to go.
Many buyers look at their pre-approval letter and think that's their actual budget. But your lender doesn't know about your personal expenses, like childcare, commuting, or student loans. Just because you're approved for $400,000 doesn't mean you should spend that much. Stick to a number that allows you to save, live comfortably, and enjoy your home without stress. A good rule of thumb is to keep housing costs below 30% of your monthly income. This includes everything: mortgage, taxes, insurance, HOA, and PMI. If your monthly income is $8,000, aim to spend no more than $2,400 on housing. That helps you avoid becoming house poor, where your home costs consume your lifestyle.
Inspections, your deal-saving secret weapon.
Another important cost is the home inspection. Although it's technically optional, skipping it is a major risk. An inspection can reveal hidden issues like roof damage, plumbing leaks, or foundation problems. It usually costs between $350 and $600, depending on your location and home size. Think of it as a safety check before committing to a huge investment. If problems are found, you can negotiate with the seller or walk away entirely. This small upfront cost can save you thousands down the line. It's one of the smartest ways to protect yourself during the home buying process.
Appraisals can break the deal. Here's how.
There's also the appraisal fee to consider. Your lender requires this to confirm the home's market value. It ensures they're not lending you more than the home is worth. Appraisals typically cost between $400 and $700. You usually pay this out of pocket before closing. If the home appraises low, you might need to pay the difference in cash. This can derail deals if the buyer doesn't have extra funds available. So it's important to plan for both the cost and the possible outcome.
Earnest money. Don't lose this deposit.
Before closing, you'll also need to make an earnest money deposit. This is a good faith payment that shows you're serious about buying the home. It's usually 1 to 3% of the purchase price, held in escrow. On a $350,000 home, that could be $3,500 to $10,500. If the deal closes, the money goes toward your down payment or closing costs. But if you back out without a valid reason, you could lose it. Make sure you understand your contract terms and contingencies before submitting earnest money. It's a key part of the transaction and often misunderstood by first-time buyers.
Utility fees. You forgot to budget.
Don't forget about utility transfers and startup fees. You'll likely need to contact power, water, internet, and gas providers before move-in day. Some companies require deposits, especially if you don't have prior service history. These fees can range from $50 to $300 per service. Getting everything set up ahead of time avoids delays or move-in headaches. Also, consider signing up for trash service or pest control if your area doesn't include it. These aren't huge expenses individually, but they add up quickly. It's smart to make a checklist and include them in your budget.
New house, empty rooms. Read this first.
Furniture is another cost many buyers underestimate. If you're moving into a larger home, you might need additional beds, tables, or seating. Even basic items like curtains, rugs, and lamps can run hundreds of dollars. Don't rush to furnish the whole house immediately. Start with essentials. Look for second-hand options or sales to save money early on. You can always upgrade once you've settled in financially. The goal is to avoid putting everything on credit just to make the home feel finished. Patience pays off, and so does pacing your spending.
What if the roof leaks? You pay.
Let's talk about maintenance and repair costs. As a homeowner, you're now responsible for everything, from leaky faucets to roof repairs. Experts recommend setting aside 1 to 3% of your home's value annually for upkeep. For a $350,000 home, that's $3,500 to $10,500 each year. You won't spend it all at once, but you should be prepared when something breaks. HVAC repairs, plumbing issues, or even simple wear and tear can come up unexpectedly. A good rule is to keep an emergency fund separate from your reserves. That way, you're ready for both planned and surprise expenses.
Yard work costs more than you think.
Another cost to consider is landscaping and outdoor maintenance. If your previous home didn't have a yard, you might not own the tools you need. Lawnmowers, rakes, hoses, and other supplies can cost hundreds of dollars. You may also want to invest in mulch, plants, or patio furniture. If you're part of an HOA, there may be specific guidelines you need to follow. Some neighborhoods even require regular lawn care or fines can be issued. Hiring professional landscaping help adds convenience, but comes at a cost. Make sure to budget for outdoor needs, especially in the first year.
Why you might pay property tax before you move in.
Many buyers are also surprised by how early property tax payments are due. Often you'll need to prepay several months of taxes at closing. This is held in escrow to ensure there's enough in your account when the bill comes due. It's a common practice, but it can add several $1,000s to your closing costs. Homeowners insurance may also require a full year paid up front. These prepaid items are sometimes overlooked during early budget planning. Ask your lender or agent for a full breakdown of these prepaids. They're real costs that hit your wallet before you get the keys.
Closing costs, the full ugly list.
Let's revisit closing costs with a quick breakdown. Common items include the lender origination fee, credit report fee, and underwriting fee. There's also title insurance, title search, escrow fee, and the recording fee for the deed. Appraisal and inspection fees are often paid separately, but still part of the total cost. If your home is in a flood zone, you might be required to purchase flood insurance. This can increase both your closing and monthly costs. Every closing is a little different, so getting a personalized estimate is essential. Don't rely on ballpark figures. Get specific numbers early in the process.
Can sellers pay your fees? Maybe.
Some buyers ask if they can get the seller to pay their closing costs. The answer is yes, but it depends on the market. In a buyer's market, sellers may offer concessions to help you close. But in a hot market, you may be competing against others who waive those requests. If you do get seller help, it usually comes as a credit toward your closing costs. There are limits based on loan type, so your lender will guide you on how much is allowed. Just remember, you can't rely on seller help. You need to be prepared to cover it yourself. Any concession should be treated as a bonus, not part of your baseline budget.
Why timing your house purchase could save thousands.
Timing your purchase is also a financial factor. The time of year can affect home prices, moving costs, and availability of professionals like inspectors or contractors. Spring and summer tend to be busier and more competitive, while fall and winter may offer better deals. However, slower seasons can also mean fewer homes to choose from. Moving companies may charge more during peak months due to higher demand. Even interest rates can fluctuate seasonally or based on market conditions. Being flexible with your timeline can give you more negotiating power. Patience often leads to better prices and less buyer stress.
Before you shop, check these boxes.
Let's talk about how to prepare financially before starting your home search. The first step is getting pre-approved by a lender. This gives you a realistic budget and shows sellers you're serious. But don't stop at pre-approval. Take the time to calculate your total cost to close. Include your down payment, closing costs, reserves, moving expenses, and setup costs. If you can, aim to have 10 to 15% of the home price saved before you make an offer. This gives you a cushion and protects you from unexpected issues. Starting with a solid foundation makes the entire process smoother.
Do not buy furniture yet.
You should also avoid large purchases before closing. Buying furniture, opening new credit cards, or financing a car can hurt your approval. Lenders monitor your credit and finances up until the day you close. Any big changes can raise red flags and delay or cancel your mortgage. Stick to your budget, keep your job stable, and don't touch your credit unless necessary. This is not the time to switch jobs or co-sign for anyone. Even a minor mistake can derail the entire process. Once you have the keys, then you can celebrate with bigger purchases.
The realtor you hire could make or break your budget.
Working with the right real estate agent also saves money in the long run. An experienced agent will help you navigate pricing, negotiations, and contract terms. They'll guide you on how to structure offers that protect your interests. A good agent also knows local costs like taxes, HOA fees, or special assessments. Their knowledge can help you avoid expensive mistakes. Plus, in most cases, the seller pays the buyer's agent commission. That means you get expert guidance at no out-of-pocket cost. Choosing the right team matters just as much as choosing the right house.
Smart tools to plan like a pro.
Technology can also help you plan smarter. There are online calculators that break down your monthly mortgage payment, including taxes and insurance. You can also find tools to estimate closing costs based on your location. Use these to test different down payment options and loan types. Apps like Zillow, Redfin, or Realtor.com can help you track property values and market trends. But don't rely on online numbers alone. Verify everything with your lender and agent. Use tech as a starting point, not a final answer. When used wisely, digital tools can keep you informed and empowered.
Knowledge is power, and now you've gotten the tools to buy smarter. Thanks for watching. If you learned something new, drop a comment below. I love to hear your thoughts. And don't forget to grab your home buying guide. There's a link in the description and comment section below of this video. Until next time, be blessed.